everyone. I hope that you're all keeping well. I'm joined today by Mark Shields, Investment Director at Brooks Macdonald, who together with his team manages the Brunsdon funds. As we move towards the end of the year, and indeed a much talked about budget later this month, a number of points are widely discussed, and we look to address some of these today. So, Mark, good morning. How are you?
Very good, Brian. Hope you are too.
Yeah, indeed. Mark, there has been increased talk about the bubble in the AI tech space. What are your thoughts on this?
Yeah, this is something that's kind of been sort of, cropping up more and more in sort of mainstream press over the past sort of, few couple of weeks, really. And in fact, we saw, as I'm talking to you today, we saw a bit of pressure on tech companies in the US overnight. As kind of there were some concerns being sort of asked about the heightened valuations that they currently sit on. Our sort of thoughts on the AI tech space have sort of been fairly consistent for a little while now. We do think that there is, certainly these companies are expensive. They have been sitting at large valuations or high valuations for an extended period of time. And now they also constitute a very large majority of, supposedly diverse indices like the S&P 500. So, we've got a bit of a combination of concentration and valuation risk within the tech space that does make us nervous. We've also seen an increased degree of sort of co-funding within those tech companies as well, which again, historically has not always ended terribly well. And whilst maybe we do think that the longer term story for AI is probably very positive, and we do think that AI has the capacity to change how people work, how they interact with each other, how they interact with computers, machines, how their lives may change based on the usage of AI. We're also quite aware that this is a marathon and not a sprint, and there's every possibility that we could see some pressure on these lofty valuations that we're seeing from some of these tech companies at some point in the future. The big question to us really is whether that's happening now as we speak, or whether they're going to grind higher for another year or 2 years. We don't really know. But we are conscious that there are, as I said, a greater degree of risk in that part of the market than maybe we would usually be comfortable with.
Yeah. So bearing in mind the Brunsdon funds, the Adventurous and the Cautious, how have you positioned these portfolios in light of your views?
Well, certainly in terms of the Adventurous fund, we're currently running the portfolio around about, well, our largest underweight at least is to the US, and the largest sector underweight is to technology. Despite us playing tech as a dedicated theme, we're in a slightly bizarre situation where there's a high degree of exposure to the Magnificent Seven and the AI theme from just buying the S&P 500 than there is from buying a sort of more diverse tech fund, which is a slightly strange situation to be in. So we are running those two areas of the portfolio at significant underweights. We don't want to sort of push that too far, though, I must be honest, because as I said, there is every possibility that we could see things, kind of moving on further in the tech space before we kind of have any real pressure. We've also made a little bit of change or some changes to the makeup of the funds that we hold within the tech theme as well. So we noticed that quite a few of the active funds were kind of quite highly correlated to the S&P 500, quite simply because the S&P 500 has such a high proportion of technology companies in it now. It's north of 40%, 45%. So we've swapped out our active tech funds for another tech fund, the Fidelity Global Tech, that actually is kind of positioned quite differently. And it tends to be a little bit more defensive, tends to be a little bit more valuation focused. So we think that is a good approach. We're both underweight on an asset allocation level, but also more diversified from an asset selection level.
Okay. So coming away from the AI tech space just for a few moments, are there any other areas in the UK market that you feel look better value?
Yeah, I mean, indeed, I think kind of, parts of the market sort of certainly globally. I mean, the UK as a whole, we do think looks quite a bit better value than the US, for example. The UK is, trending at a much lower PE than the US is at the moment. But we also think there are opportunities, within markets like the US, which are optically very expensive because they've been made very expensive by one or two sectors, but actually there are other sectors in the US in particular, but also globally, that are looking relatively cheap. And healthcare is a good example of that. Healthcare's had a tough 18 months. It has come under quite a bit of pressure as we've had overhangs to do with kind of the most favored nation drug pricing, issues with the Trump administration, Robert Kennedy Jr., the kind of changes to the Medicaid in the US, et cetera, et cetera, et cetera. But we started to see some of those overhangs dissipate, and the healthcare market, certainly in the US, is essentially as cheap as it has ever been. And globally, again, that is a very, very kind of depressed valuation we feel there, and we think there's some pretty decent opportunities that may well be sort of potentially acting as a bit of a counterbalance to areas such as technology, where you've got a sort of a very expensive sector, and we think a relatively cheap one like healthcare could well offset some of that risk as well.
Okay, well, thank you. Okay, well, thank you, Mark, and thank you all for listening. As always, if you have any questions, then please be in touch with us.